Few very important things we're going to address in this video. Why were we buying calls yesterday when the markets were crashing 700 points? We're going to give you a specific answer to that. Number two, we will take a look at the history of the fear factor, the VIX, to help us understand what will actually happen in the market next, both short-term and longer term. And at the very end, I will give you a simple strategy that you can apply in your trading starting tomorrow. So here's what we were actually doing with our 13 Market Moves Daily subscribers yesterday when markets were dropping down 700 points. Yes, we were buying calls all day. Here's the message that actually went out pre-market to our subscribers saying, we don't want to buy puts on the drop. Wait. And after that, we started loading up on calls throughout the day. Now, here's the most important thing. Why? What you don't want to do is you don't want to buy a ton of puts after the markets have been dropping consecutively for a few days, because there's always a probability, a heightened probability of a bounce. More importantly, especially as predicted in the prior videos, we said that once the market was ultimately going to drop, even though it was going to be disregarded until the drop happens by most of the analysts who has a short memory for remembering the 1,000-point drops that were taking place in November, December last year. But once that was going to take place, they were going to come in and say, let's buy the dip. Again, we don't want to buy the news. We don't want to sell the news. What we want to do is position ourselves where institutional money is going to go. And if they're buying the dip, then clearly we don't want to be buying puts. So just remember this picture right here, guys. Think of it as the lower trading range and the higher trading range. This is a photograph of S&P futures, and the lower trading range right now for the S&P 500 would be that level between 2,800 and 2,820. So in this range, it seems like institutional investors, they're buying stocks. Now, what would be the higher trading range? The higher trading range would be this area of 2,880, 2,890. What you want to do is simply buy calls in the lower trading range. You want to sell calls in the higher trading range, and you want to buy puts in the higher trading range. Everything else is just in between. Don't expect the markets to drop continuously for a number of days in a row. Don't expect the markets to continuously climb. And certainly expect different movements throughout the day, meaning if overall they're moving the markets from the lower trading range to the higher trading range, don't expect this to continue just like a one straight line right in the middle of this photograph. Expect it to have a gradual stair-step kind of circumstance of direction to where over the course of a few days, you can move from this area of 2820 to 2890. Okay, with that said, here's the answer of why specifically we continued to buy calls, not just shortly after the market opened, but throughout the day. This is a photograph of VIX, and what you will see here is in these purple lines, actually this is the overlay of the S&P futures. So what was happening on Thursday is we had a VIX spike to 2338. Now notice S&P was moving lower, but not as low as it did yesterday on Monday. Okay, so Monday the markets were crashing, but what happened to the VIX? Well, the VIX hit a handle of 21 and just stalled there. Like it literally traded just above 20 for some time, and it was really hesitant to move higher. Now, just think about it. On the day when markets are crashing 700 points, don't you think VIX should be rocketing higher? Rather, instead of doing that, VIX was very much contained within that trading range between 20 and 21, where it should have set a new high, actually exceeding the high set on Thursday of 2338. It actually didn't even move nowhere closer to that. Basically what we're saying, it's a simple case of a divergence, and I went into divergence describing how to identify these divergences intraday. Now this one is just on a larger scale. When we're identifying divergences intraday, we take a look at the 1 day, 1 minute chart, 1 day, 5 minute chart. This we're taking a look at a 5 day, 15 minute chart, a 5 day, 5 minute chart. So clearly what you're going to observe here is this. This was the market on S&P. This is again picture of S&P futures when it was dropping to this mid-range of 2850. VIX was actually setting a high of 2338. When it moved yesterday to this level of 2800, VIX only went to 21, just above 21. So indeed, it should have gone substantially higher, certainly higher than this day right here. So simple VIX versus market divergence. And guys, if you're trying to make sense of these divergences to help you in the trading, simply click the link below. Take charts divergences in patterns recognition. That's going to empower you to become a much better trader. Now, let's take a look at the history of the VIX to determine what is actually coming here in the near future. So we're going to start with a 19-year chart of the VIX. And the first dot, pay attention, write this down if you want to, guys. The first dot represents a level of about 35 to 45 level on the VIX right here, which coincides with what? It coincides with the year 2000, 2001, when what was happening? The dot-com bust, okay? Remember these levels, because there's key importance to that, understanding what causes what. So shortly after that, clearly looking at this historic chart, what is this? Well, that's the crash of 2008, 2009 financial crisis right here. To keep things in perspective, VIX reaches pretty much 100 level here. So dot-com bust, 35, 45 level on the VIX. Crash of 2008, 2009, VIX spikes to 100. Now, what are these dots right here? Let's examine these dots right here. Now, these highs on the VIX. VIX reaches a level of roughly 50. Here, 15, 16. This was actually in August. Why did it do so? Well, this particular time, VIX spiked to this level of 50 because of the Chinese fears, because Chinese economy was slowing. And we actually had a couple of days in August where the markets were crashing like crazy by more than 1,000 points. Shortly after that, they were reversed, and therefore these highs on the VIX, as you can see, they don't stay there forever. But understanding why VIX went and to what level can help you understand how high VIX goes based off what causes and circumstances later in the future. Okay, this next dot right here was February 2018, when we had the markets plummeting again 600-700 points, another 1,000 points, 1,300 points over the course of a day and a half. So this was caused by the fear of increasing interest rates. And shortly after that, okay, we actually had a spike here, which we're going to take a closer look in a second, that is very relevant to what's happening now in the markets. And the last spike we had right here to a level of 35, 36 was just a few months ago in November, December 2018. And that was again attributed to the fear of the Federal Reserve, being hawkish. And again, it had an association with the fear that Federal Reserve was going to keep increasing the rates. So the last two circumstances where VIX went to 50 and 55, they were attributed to the fear of rising rates. Notice on this chart that we have a very interesting development, just like what we've had in the year of 2007, 2008, 2009. Notice how VIX, in this case, after hitting some lows, right, a low of 10, just under 10, then it sets a series of higher lows, right? So there's the uptrend in the VIX, and then what happens? It breaks out like crazy, all the way to 100 in 2008, 2009. Now, this is similar development that we're observing now, and what a coincidence. It is actually happening exactly 10 years later, which coincides with the cycle, right? The economy is about to experience slower growth. These numbers that they keep bringing to your attention about the lowest unemployment rate and so on, just think of it in terms of that the lowest unemployment rate don't stay forever, that at some point it turns and it goes the other way. And these lower highs on the VIX are telling us that we're getting closer. So if we get another lower high on the VIX in the next month or two, we could be setting ourselves in a position where longer term we could initially hit 50, followed by getting close to this 100 level. Now, I know some of you are watching this, you're like, dude, you're nuts, you're crazy, there's no way the VIX is going to go to 100, and why would it do it, let's say, in the next 6 months? Because we're going to take a look at some other charts which should make this scenario a little bit clearer. But the very fact that we're at the end of the cycle and the very end that the charts are drawn very similar circumstances like they were 10 years ago puts us in a situation of an increased probability of something like that actually taking place. So let's take a look now at the VIX chart beginning 2002 through 2019. And here, if we zoom in again on these time frames, 2007, 2008, and now 2018, 2019, again, I got these green dots now showing you a series of higher lows. And the same time, if we draw a line right here, we got a series of lower highs. In other words, we have a situation where if we were to continue drawing these lines, they would cross, which would form actually what's known in charts as a death cross. So this was actually a situation, this is how it looked when these lines were getting narrower and closer to each other. That's when ultimately we get a breakout on the VIX reaching 100 level. Okay, then of course we trade for years, you know, with a few breakouts higher, basically going sideways for quite some time. And now, if we were to draw the same lines of 2018, 2019, we have a very similar condition, how we create lower highs on the VIX at the same time as we're creating higher lows on the VIX. So this range is narrowing. Ultimately, it will lead to a higher breakout in the VIX. Let's take a look at the VIX 2005 for 2019. Actually, what we're seeing here is clear divergence. Take a look at where VIX was trading in 2007, which was the lowest level of that decade. And what we're getting is a reading on VIX just under 10. Well, in 2018, actually December of 2017, VIX drops briefly under 9, which is unheard of. Okay, this is absolutely ridiculous. Okay, that's how complacent the markets were. If you remember, that was the first time the markets were breaking out above 26,000, 27,000 Dow. I mean, that's when everybody was happy, go, everything was green. That was about the same time Bitcoin was hitting, you know, 20,000 bucks right there. So the markets were as bullish as they get. That was the point the VIX dropped under 9 briefly. But here's the interesting part. So 2007, VIX briefly drops under 10. Where is the RSI? Well, the relative strength index actually is quite low. It's just above 30. Now this time, we're actually setting a lower level in the VIX under 9 in December of 2017. And where is the relative strength? It is actually much higher. So we're getting a divergence. Typically, you would see a breakout higher, just as it took place right here. But looking on a larger time frame, this really tells us that this divergence between the VIX and the RSI of the VIX actually could lead to a substantial breakout higher in the next 6 to 12 months. Now, if we examine the 2012 chart for 2019, we actually have a head and shoulder formation, which is known to be a reverse of the head and shoulders, which is actually bullish. And if you're unfamiliar with head and shoulders, reverse head and shoulders, guys, the same link below on charts, divergences, and patterns is going to help you understand how to read these things. It's going to help you apply them on shorter time frames, longer time frames. So if you haven't taken that course, guys, here's your chance to really create a competitive edge for yourself as a trader. So here it is. The reverse head and shoulder often leads to a bullish breakout higher from here. And again, we're looking at the time frame over the course of the 7 years. So it does not mean that the VIX is going to break out higher tomorrow. It does not mean the VIX is going to break out higher in the next 72 hours. What it does tell us is that the VIX is going to break out substantially higher, where we will revisit these levels of 50, 55, possibly higher over the course of the next year. Now, here's a couple of very important questions as we zoom in on the shorter time frame on the VIX chart. So the question is, where was VIX last April? And the importance of understanding where the VIX was last April is because that is when initially in April 2018, when we heard about the tariffs and the potential trade war beginning with China. So if we measure where the VIX actually was last April, it could give us an idea where VIX could be going now, as we're dealing with the same type of causality, as we're dealing with the same type of reasoning why the VIX is spiking because of the trade war. So number two, last time VIX almost doubled in 24 hours. What happened next? So very important two questions that we're going to give you answers for right now. VIX chart since 2017. Let's focus right here. Clearly February, VIX went to the 50 point, and that was due to the heightened interest rate that everybody was fearful that interest rates were just going to get out of control. They're going to go significantly higher. So VIX goes to 50, 55 level. This orange dot right here coincides with March, April. That's when the news broke out about the tariff wars. And VIX, as you can see, went to a high of about 27, 28. Now, at that point, that piece of information, the news about the tariffs, was highly unexpected by the markets, or to the majority of the market participants. So that's why it hit this level of 27, 28. Now, notice as the fears were bouncing back and forth in the news, all the crazy headlines, it really hesitated to move above that level. And now we are recently, because of the trade war situation, we hit a high of roughly 22. As I was just pointed out, 23.38 was the highest. And chances are we're not going to move much higher on the VIX anytime soon. Definitely not over the course of the next couple of weeks here, because now, a year later, the news about the tariffs, number one, we shouldn't be hitting the same level based on the same news or information. The news about the tariffs is not as fresh or unexpected as it was a year ago. So it would make sense that it would set a higher level on the VIX a year ago for the same reasons, but not now because the information is just too old again. So, however, this 22, 23 level could be a temporary high on the VIX. And if we examine any situation where VIX has doubled in 24 hours, just like we had the circumstance here, it didn't stay there very long. As a matter of fact, there's not actually a point in time with the VIX where it didn't give up those gains shortly after that. Okay, now there's clearly some things that are developing on this weekly chart. For example, there are bullish, such as this bullish crossover that's being formed on MACD, which tells us that over the longer time frame, even though VIX could give up some of the recent gains, it will ultimately move higher. This photograph was taken on May 7th. But notice, anytime VIX spikes within a very short amount of time, very quickly, look at all these points that I highlighted here, it has a tendency to give up those gains rather rapidly. And we believe this is going to be the circumstance here with this situation again. Now, here's this VIX weekly chart. And on this chart, I want you to focus on what we believe is going to happen next. Even though we're getting a bunch of bullish readings, again, it does not mean that VIX all of a sudden it's going to drop. But this level that I've got circled here of 16 is of critical value to any trader. Because if you study the history, anytime we've gotten close to this 16, we have bounced higher. Maybe back to this area of 20, but shortly after that, we expect the gains to be surrendered. And we could be going into this setup right here, highlighted and circled by this orange color, where VIX could actually drop under 16. And if this is where we headed short-term wise, VIX going to 16, and it is actually going to break under 16, then the best strategy is to just simply buy calls. In our video we posted on the trade reversal opportunity when the markets were crashing in December 24th, we've actually nailed the stop. We've been able to identify to our subscribers that from here on it made sense to buy calls while everybody was still fearful of further market drops. And we got nothing but substantial move higher in the markets. If you haven't watched that video, it's somewhere on the channel posted just after December 24th, where everybody was talking about how the market was going to continue to crash. So the significance of 16, however, if we revisit this level, today VIX actually trading so far, I think about 1920. But if we revisit this level of 16 in the next few days, but we don't break below that, this would be a good entry to actually buy VIX calls once we do get to 16, which could coincide with levels on the S&P 500 of about 2880, 2890, because from there we could stall and reverse moving lower, which coincide with the earlier picture I was showing you guys of the higher trading range in the market right now, if we look at it from the standpoint of the S&P. So the most important numbers for trading this week, again, is going to be 16. While VIX is downtrending back to 16, it does make sense to just buy calls on S&P and top stocks like, you know, Amazon and so on. And if VIX actually drops below 16, it would make sense to buy more calls. Now, if VIX gets to 16 but bounces off of the 16, it's going to be time to be buying puts. So this is a very simple strategy, guys. Anybody can follow. So if VIX is in a downtrend, working its way back to 16, you want to stay on the call side. If it breaks below 16, you actually want to buy calls and stay on the call side, because then the probability is it's just going to be side trading between 12, 13 range and 16 for some time. And then if VIX bounces off 16, that's when you want to come in and buy puts on the market, and you want to buy calls on the VIX. Now, let's take a closer look at where we could be heading longer term by taking a look at one more chart. As you know, copper is a pretty good indication of what's going to be happening globally, economy-wise. So head and shoulder on copper. So when we combine current observations on the VIX with the chart of copper, this is what our conclusions are, the key takeaways. So in recent history, last 3 times VIX doubled in 24 hours. It resulted in the VIX hitting 55, 28, and 36 levels respectively before beginning downtrend. It's reasonable for VIX to revisit 16 handle in the next 10 trading days after hitting double, triple top about around this 22, 23 area. Point number 2 is in the next 90 days, VIX could easily revisit this 35 handle, and we expect it to happen by August, September. And in the next 24 months, VIX is likely to escalate above 70 at one point, as volatility typically increases at the end of each cycle. Guys, if you have any questions about trading stocks, trading options, trading the markets, feel free to get some extra free trading bonuses by clicking some links below this video. Simply visit our site at tradingoptionslive.com. Review. There's tons of information that would be helpful to any trader out there. So guys, take action. This is going to be an exciting market. When the volatility starts spiking and going wild and crazy, creates all sorts of opportunities, both on the put side and the call side. This is time to take action and make this year your best trading year ever, guys. I'll catch you in the next video.